All right. Good afternoon, everyone, and welcome to the Access to Capital panel with Rise Up Philly. We've got three panelists here. My name is Terry Booker. I'm a Vice President of Corporate Development and Innovation with Independance Blue Cross, and I'll be your moderator today, just kind of guiding the conversation. And that's exactly how we're going to have this session, as a conversation. So I'm not certain if you as viewers can actually put in chat questions, but that might be an opportunity. I'll check with our producers to see if we have that capability. So we've got yes, and I'm being told that yes, you can put your questions in chat. And so we've got three guests today. The first is Saj Cherian, who is a partner with Kinetic. Next up is Hope Doyley-Gay, who is with Spirovent Sciences. And last up is Richard Snow, who's with newly monikered WSFS, otherwise known as the Wilmington Savings Fund Society, right? Right, Richard?
That is correct.
All right. So if you guys wouldn't mind, would you take just a few minutes and give our viewers a little bit of background about your company and your role?
Well, thanks, Terry. Again, I'm Saj Cherian. I'm a partner at Kinetic. We own three e-commerce companies, Fanatics, Rula, and ShopRunner. And actually, it's really two, because we just sold our smallest company, ShopRunner, to FedEx last week. So it's pretty exciting news for a company that was started here in Philly. But really my focus, I was a VC in the past, a mobile guy from an operating perspective at places like Virgin Mobile, which gave me my startup experience, as well as NBC, and really just excited about being part of the Philly startup ecosystem. So Terry, thanks for the opportunity to spend some time with this group.
I think I just bought something from one of your websites, like while we've been on the show. You're up next.
Hi, again, my name is Hope Doyley-Gay. I am General Counsel and VP of Administration at Spirovent Sciences. We are based in the University City section of Philadelphia. We started there back in 2016 and have grown since then. We are now a wholly owned subsidiary of Sumitomo Dynapon Pharmaceuticals based in Japan. So my background is I'm a lawyer by training, and I was general counsel, or not general counsel, associate general counsel at a large pharmaceutical company for about 15 years, the entire time doing deals, acquisitions of smaller startup companies, just like the one that I'm a part of now. So it's been fun to be on both sides of the aisle. So great to be here as well with Rise Up Philadelphia.
And thank you for joining us, Hope. Next up is Richard Snow.
My name is Richard Snow, the VP, Vice President for the National SBA program at WSFS Bank, Wilmington Savings Fund, but we also like to call it, we stand for service. And it's easier to say WSFS, W-I-S-S-F-I-S-S, WSFS. Been around since 1832, one of the oldest financial institutions. I'm also a board member for the International Franchise Association on the Diversity Council, where we're geared towards our goal and mission is to push the diversity metrics for franchise ownership by 2030 and make it one of the most diverse industries in the U.S. I'm also a past board member of the National Black MBA in the Business Center for Entrepreneurship, and I'm very proud and an advocate for access to capital for minority entrepreneurs.
That's awesome. I just looked at the backgrounds, and three of us have been sort of in the venture caps startup funding area. That's one of the areas that I've been involved with Independence Blue Cross, is we have been a participant with Dream It, and also have been an investor in a number of local startups as a result of our Dream It work, and also as a strategic investor. So we're not a financial investor. But as I look at that, Hope, your background and Saj's background, can you guys discuss a little bit, what you see as one of the critical elements for accessing capital, that first pitch when you're coming up with your idea? Both of you are from the equity side, but maybe Richard, you can also answer that in terms of what people need to be sharing with you as they look at debt?
Absolutely.
So Saj, why don't you start off?
Yeah, sure. I think the starting point is always, what about you or your company or your team, your product, what is different? I think, increasingly, it's really important for that differentiation to come out in your pitch, because ultimately there's a lot of startups and a lot of companies that are tackling similar areas and they have similar ideas. And so I think you have to, really outline, a compelling narrative around what makes you, your team, your product, different. And then ultimately, why that partner or that investor is relevant and why you really need them as part of the journey that you're on in taking your company from a concept to, an idea and product and ultimately a very successful enterprise. So be different. Why are you different?
Yeah, and Hope, you've seen that same approach on the life sciences and pharma side, that typically takes a ton of capital to get things going. So can you talk about, there's a lot of differentiation and specificity in your world, so can you talk, how do you make that relevant?
Sure. No, I think, as Saj just said, differentiation. I mean, and even though a lot of what we do is novel, there are some things that are, maybe just line extensions, just kind of improvements of what's already out there. So really trying to make potential investors understand what differentiates your technology. Does it make something move faster? Does it get you to, does it somehow improve what's on the market now, or is it truly novel? And then, and especially in our world, you may have the best science, but if you can't get it to market, then it's somewhat really not helpful. So what are the steps that you thought about to kind of get it there, from the development stage to kind of the concept, and most importantly, can you make it, and get it out to market? Those are the kind of stuff you need to at least show potential investors that you've thought about, particularly in the life sciences space. But I think that also translates, frankly, into any industry.
Mm-hmm, mm-hmm. Richard, can you talk about that from the SBA and franchise space in terms of how, in many cases, those are not new ideas. That is a person who's taking on a brand or something that currently exists. So what do they have to show you to display that they are worthy of being backed for loans?
Well, even though they're buying into an existing brand, it is still a new startup. So we're going to look heavily at that guarantor and their transferable skill sets. What team are they bringing to the table, and how does that transfer over to the project? And can you take that project or that company to the market successfully? So we want to understand your background, your narrative as far as your marketing plan, your SWOT analysis, and then your command over your projections. The projections is really the heart and soul of that plan, looking at, does it have the ability to service the debt that you're requesting from the bank? Are they well thought out? Can you make it past your ramp up stage? We know the first 2 years of a business is the most critical, that capital needed. And if we're going to provide that capital, we want to know that you can make it out of ramp up and that it will not turn into a loan that will default or a loan that needs that additional capital support.
Yeah. Saj, can you talk a little bit about, for Kinetic and ShopRunner and Rue La La, how you all got your start? Was it friends and family? Was it some other larger investor? Can you talk about that?
Yeah, well, we had an interesting start. So, for us, our previous company was a company called GSA Commerce, which was a leader in the e-commerce and largely outsourcing space. So like a lot of the big brands, Dick's Sporting Goods, Apollo, Toys R Us, basically outsourced their e-commerce operations to GSI, which was based in King of Prussia. And then we ended up selling GSI to eBay, because eBay was really going after the B2B businesses, the clients that we were serving, but we kept the 3 direct-to-consumer businesses. So as part of that transaction, we actually we acquired the 3 direct-to-consumer companies: Fanatics, which is the largest seller in licensed sports merchandise; Rue La La, which is leader in the fashion space, and then ShopRunner. But we financed that actually sort of through sort of a seller financing. It was largely debt, and so that's kind of how we got our start. And then ultimately, we raised capital in each of the different companies, as the businesses went through. So ShopRunner was actually incubated within our old company GSI. Rulala was actually an acquisition, of our prior company, and Fanatics was sort of the sports business that was started within GSI, and we ended up bringing on the various leagues and then colleges and et cetera. So it's sort of a non-traditional path, but I think you have to be creative, I think, at times, and take advantage of those opportunities. So the fact that we were able to kind of sort of finance the acquisition, sort of through debt from the acquirer was sort of a novel way for us to kind of get our start back in 2011.
Sure. Now, Hope, often in the pharma space, there's a lot of support by larger entities that are hoping to partner with smaller companies. So, do you go it alone, or do you always get that large big pharma partner, or that larger partner that's in your markets already?
Yeah, no, that's a great question. Some companies do want to take it all the way. They want to not just develop the drug, but also develop the infrastructure to manufacture and then later on commercialize it. But more often than not, because a lot of the smaller biotech, cell and gene therapy companies are funded with VC money and other money, they don't. That's not where they want their money spent, on building a large manufacturing plant or bringing in a lot of employees. What a lot of small biotechs find they can do is they can get enough money to get through that initial research, that initial development, maybe a phase 1, a phase 2. And then at that time, they usually may partner with a larger pharmaceutical company when you start to getting into your phase 3 studies, which get very large, very expensive, and then preparing for commercialization. So you don't have to. There's nothing that says you have to partner. But a lot of times your investors sometimes dictate that. They may not want you to build to that scale of what you would need for a large pharmaceutical company to manufacture and bring a drug product to market.
Gotcha. Now, going back to your early days, Saj, how much cash do you think, going back to before you sold to eBay? I mean, we all know that eBay's a big company, and that was probably a pretty successful deal for you. But how much cash, if you recall that back to then, did you guys have to have before you felt that you were visible to these other parties? And I would ask the same thing of Hope for you. And then, Richard, I have a couple of questions along that line for you as well.
Yeah, so GSA Commerce was started by my partner, Michael Rubin, and, he, sort of started it out of a predecessor company, sort of in the closeout business. And so he saw the trends back in '99 of where the internet was going for retail, and sort of invested in there. But I think from there it was really started out from a services perspective. And, part of it was really scaling up in terms of on the base of a number of different clients, and then looking to capital to really accelerate the growth. So one of the things that we really focused on at GSI, because we had to make a lot of investments in technology and sort of fulfillment and back-end systems and in marketing, was to really get into long-term agreements with our partners. And so that really allowed us to kind of, and make those types of investments, going forward. So again, it started out as a services business, and then we used growth capital from a number of different sort of institutional players to really accelerate our growth and have that scale that allowed us to, ultimately become a multi-billion-dollar company based here in outside of Philly.
Sure. Thanks for that. Hope, can you give a little bit of background on Spirovent and what and its product line, and then also, a lot of that is development, and you're always pre-sale. So again, having money, you're doing a lot of work before you actually generate revenue. So how long do you have to be able to hold on?
Yeah, we are a pre-revenue company. So Spirovent is a gene therapy company. focused on respiratory diseases of the lung. But right now we're focusing on cystic fibrosis, which is a rare disease. The company was started in Philadelphia in 2016 by Militia Hill Ventures, Jane Hollingsworth and Joan Lau, as well as 5 founders who were based in a university where we in-licensed what we viewed as their world-class technology, gene therapy technology for the treatment of cystic fibrosis. And we formed a company around that. And the money you get is kind of a sweat equity. You do a lot of the work without being paid. You also get grant money. We have an amazing science center here in Philadelphia. They have a fund that they grant money to young pharmaceutical companies, startup pharmaceutical companies. There is a patient advocacy group specific to cystic fibrosis that also gave us initial grant money. So that kind of was our seed money, if you will. And then as we started, we needed more money again in that space. We obtained some grant money from another group, not even a grant, it was a convertible note from a group, and then a sizable grant from a disease-specific foundation that helped us along the way. But again, in this industry, you just need so much money. So at that time, I guess in 2018, we actually started to look to do a full raise of capital, because that's what we needed to progress our programs forward. And at that time, we were acquired by a company called Roivant Sciences. And that's the infusion of cash. That's the exit that a small company usually needs to get to that next step, to be certain that you have that base of capital to get you through clinical trials and on manufacturing and commercialization. Roivant Sciences last year subsequently sold us to Sumitomo Dainippon in Japan, and the same thing. That is this kind of source of capital that you need. But there are lots of things we could do. Again, when I was in large pharma, a lot of the partner deals that we did were licenses, collaborations. You don't have to sell everything to the big pharma company. You can partner with them and still try to keep some control of your asset as you move forward.
Mm-hmm. It's interesting that you talk about that, just in terms of, there are entities here at Philadelphia, like, the Philadelphia Industrial Development Corp, PIDC, that some of our viewers may want to reach out to. In addition, there are partnerships with entities, like Jefferson University, Thomas Jefferson University, entities like Independence Blue Cross, that can also provide creative and strategic funding for a lot of these things that are going on. We do have our first question, and I think this one is for you, Richard. And the question is, how do I know if I would be able to qualify for the funding I would need to start my business or buy into a franchise?
So one of the first things you want to take a look at is your character, your transferable skill sets, and then your capacity and liquidity. Do you have the cash sufficient enough to support that particular franchise? So when I back up to the normal entry point is a franchise consultant. The franchise consultant matches you with the brand. Once you're matched with that particular brand that you're have a synergy with, that matches your skill set, then from there, they'll give you what is called a franchise disclosure document, an FDD. There you have the total project cost, what it's going to take to take that from startup to build out, leasehold improvements, inventory, the working capital needs, to the point where you can launch that business. Now, once you bring that to the bank, WSFS Bank, and we're able to look at that information, we look at, typically you need anywhere from 10 to 30% cash injection of that total project cost. For startup franchises, 20% is normally where you will sit as far as your equity injection, your cash in. And if it's a partner, you can split that between you and your partner. That can come from cash. That can come from a Rob's transaction if you choose to use retirement assets. Multiple ways that you can come up with that equity injection. Then
Richard, let me stop you right there. That 20% that you're talking about would be original, like, owner's equity, correct?
Correct.
So that's what that person would need to come to the table with in order to then potentially secure a loan from you.
Correct. That would be your owner's equity. Now, one other aspect at play is the collateral piece. They will take that first lien position, as we spoke about previous, Terry, against a primary residence. That's also part of your skin in the game, to mitigate the mitigation of risk to the bank. and making sure that you're pledging that collateral to support your business. And it doesn't need to be one-to-one, but it just needs to show that you a show of support for your business and the success of that business. And then your credit score. Credit plays a big role into this. Normally 700 or higher is what the banks look at from a credit standpoint. And then making sure that that business look at the historical of the franchise, but making sure your projections service the debt of the loan that you're requesting.
Sure.
So those are some ways that you would look to know if you qualify for that franchise.
So this is a fielder's choice for any of you. Can you talk about how you put together your financial projections against which in your case, Hope, you had grants and other monies. Saj, you guys had a services business that ultimately you levered into something else. How do you put together those financial projections to tell your story? Don't all jump at once.
Okay.
Well, for Spirovent, with respect to our source of financing, source of funding, you kind of look at the pot of money that you have, and we work backwards from there. Where are our programs? What work do we have to do to get them to get them where we want them to be within that limited funding? And frankly, that's what necessitates you seeking more funding when you see, okay, we're seeing good progress here. This product is moving. We need to do additional studies. We need to get additional, anything in order for you to conduct your experiments. You may need more people, and that kind of drives when you put out your projections for what is the timeline, your development timeline for your product, for your programs. That helps just as you're trying to raise money as well, so people can actually see. I think, as someone said earlier on this call, just where you're going, plotting it out so that they can see the end game and they're willing to invest in that.
Sure. Go ahead, Saj.
No, I was just going to say that in terms of, from a technology, sort of startup perspective, the way I like to think about, sort of the investment rounds are like you're running a series of experiments, right? So you're starting with a friends and family round. You're trying to take an idea and you're trying to turn that into, potentially a product. And then, you have your sort of Series A where you're saying, hey, I need to really validate consumer adoption of that product. And then whether that's a consumer or, an enterprise customer. And then ultimately, your Series B and your Series C are where you're thinking about, how can I scale this and, what marketing investments I need. So I think with each funding round, you want to put financial projections that sort of take you to sort of those milestones. And I think you want to be somewhat conservative because you always want to make sure that you sort of, you want to over deliver, right? So under promise and over deliver. And sometimes also, you might be talking to a Series A investor around the friends and family time because you want to give them a flavor of, hey, this is what to expect. I know that, we're not trying to raise money from you now, but I'm going to come to you in the future, but I'm going to tell you what I'm going to do. And so when you meet them, down the road, when you're ready to raise that Series A, you told them I was going to hit X milestones and I hit X plus Y. And so overachieving gives people confidence to say, hey, look, when last time I talked to them, they said they were going to do X, they're doing X, Y, and Z. That gives me confidence that when they take these dollars, what are they going to do with that? So I would say, think of your financial projections in line of achieving certain milestones in terms of the experiments that you want to run and ultimately the success that you want to have.
Mm-hmm. It's funny that you go ahead, Richard. I'm sorry.
And in the franchise space, you have historical markers. You can compare city to city. So if you're opening a McDonald's or Five Guys in Philadelphia, you may want to cross compare to what it would be like to open up one in Atlanta or one in New York, and look at the population density. And how they are actually creating revenue based off of that model. So you have a model to compare your revenue projections to get an idea, and you look at the median household income, family size, the affluency of that particular area, because location is key, especially in the franchise, where in the franchise model, where your location is at in your population and modeling after the previous success. There's the formula to it. So once you have that model, you have that location, it's really based around, your marketing, how you're going to grow the marketing, because they already have planned out how many employees you need. Typically, your human capital is 30% of your revenue as far as your expenses. From an operating capital what you need from that standpoint. And then you look at the external threats that may be taking place that's a little bit different in your market compared to other markets, and you adjust for it. You adjust for those threats. And we'll see that in your projections. So you may have a franchise disclosure document stating you need a working capital, but you know that currently in that market, there's external things taking place that's going to cause you to increase that working capital model and adjust that revenue model some. So we have the franchise disclosure document as an indicator, but then your research within your market and looking at your population allows you to customize that projection to meet your specific need.
Mm-hmm. Now, and Saj, you and Hope can speak to this a little bit, and you, Richard, front as a lender. But how frequently, for the companies that you looked at, that you've acquired, or for your own company, you have these milestones and everything's not perfect? And so how important is it that you meet those milestones, and what happens if you miss?
Well, I'm happy to, take that one first. At the end of the day, you have a vision and of where you want to go. And sometimes these experiments don't work out, right? But the best startups sort of figure out how to pivot and how to. You might be, for example, having a product and you're going after market A, but then all of a sudden you're not getting the traction that you're looking for. But then you're thinking about, wow, 80% of this product could be relevant to market B. So let me retool a bit and go after that. And so I think the best teams figure out a way. And I think if you ask people. It's easy to kind of look in the rearview mirror and say, oh gosh, when we started this company, this is exactly what we wanted to do. But I think some of the more successful companies actually found their way by trial and error and ultimately refining the product and listening to the consumer and then pivoting. Where we started. When we started ShopRunner, for example, we started out with a sort of $79 fee. And we thought, there was a ton of value for the consumer and we're off to the races. But then, we sort of realized that $79 fee was a stumbling block for consumers to adopt. So we actually partnered with financial services players, folks like Amex, that gave the ShopRunner benefit, which is 2-day free shipping in an Amazon Prime-like product away to their kind of best customers. And so we eliminated that $79 sort of barrier, gave it away for free, but our goal was to drive increased frequency, increased conversion to our retail partners. And so when we lowered that sort of barrier, pivoted the business model, the growth, just sort of exploded, from there. So sometimes you got to change the business model. Sometimes you got to change, the market that you go after. And so you can't be afraid to fail, but you gotta react quickly and pivot, and then explain that logic to your investors, both current and prospective.
Was that pivot strategy something developed internally, or was that something that you worked on with any investors or any strategic partners at the time?
It was actually from talking to a number of our partners, and both current and prospective. We were talking to a number of players, and they were saying, like, gosh, you guys, if you gave this thing away for free, you'd be a much different company and you'd be able to scale. And then we're like, well, okay, well, how do we afford to give it away for free? And so that's where we had to sort of bring in a payment partner like American Express and eventually PayPal and others, to help sort of fund that sort of benefit. So I think it's about listening to the marketplace, both your partners, customers, and different folks in the ecosystem. And so we're always listening, to improve to prove our product, but also our prospects.
I cut somebody off. Richard, you had a comment.
Yeah, and I think your question, Terry, is really poignant for this current time because every business is off its marker for the most part. We're in a COVID-19 economy. Most businesses are operating at 30% of what they typically operate at. And you have to show more control over your expenses. So when and you're still coming to the banks for PPP, idle to the SBA, working capital from the financial institutions. And you're really explaining that narrative of historically, how did you perform? And currently, how are you performing? And how are you getting back to 100%? How are you working within this COVID-19 environment? What changes are going to be permanent to that change? Which changes are just fluctuating? And again, speaking to how do you pivot through that economy, having that conversation. So right now, a lot of businesses come to us at the bank and they are all showing us their financials. And they're saying, hey, from quarter one to quarter two, quarter three, we were down by 30, 40%. But look at our incremental rise. Look at how we controlled our expenses. So that's a conversation we're going to have for the next 2 years, because you're going to look at how, if a business is still, and this is what COVID did for the most part. If you were on the brink and you were struggling prior to COVID, COVID pushed you over that brink. If you have good control of your expenses and good control over your revenue model and you're able to pivot, you became lean, but you're still able to see it through COVID-19. And now you see the increase up back towards the trend of getting closer to 60, 70%. So it's really that conversation. And if you go a year out and your industry as a whole is rebounding, but you're not rebounding within that industry, then now you have a different conversation of what else is affecting you, what else is needed to support you. So just really understanding where you sit within that market, your ratios compared to the market, and where you sit as far as working within a pre/post COVID-19 economy. That's going to be a narrative question that we're going to have for the next 2 years.
Sure.
Yeah.
Go ahead. Hope.
No, Terry, I was just going to add, I think no matter what your industry is, people do not expect a straight line. They expect deviations. Problems are going to come. Unexpected things are going to happen, whether of your own making, from or from a third party, or in my industry, we're heavily regulated, so things are constantly changing. Your investors know that as well. So as these folks said, it's continual communication. I've seen on both sides. I was with big pharma, and we were the investor in the small biotech, and then on the small biotech side. As long as the people are communicating, no one's surprised by deviations in the plan. It's just how do we manage that going forward?
So I guess what I hear you all saying is really over communicate, no surprises, particularly with your investors and your partners, and trying to leverage those relationships so that you can potentially pivot and get to the trend line that you thought you would have it at the outset.
That's it.
Exactly.
Gotcha. We have a couple of questions. I'm going to take them in reverse order of what of where they came in. So this is the last one. So can the speakers comment on the number one indicator of success in a startup team? I know Saj, you've been there and acquired companies. Hope, you were an executive in residence, and of course, Richard, you see people coming to you every day. So I think this is a real important one, in terms of that indicator of success, or better yet, maybe there's not one thing, but maybe there are a couple things that you think are most important.
Well, I can jump in on the funding side. When I see a new entrepreneur that's really a student, they have more. I've seen entrepreneurs have more of a command over this new franchise business than some of the franchisors. To the point, some of the projects that they're putting in place, their ideas are highly receptive from the franchisor. They're implementing those plans nationwide. They may have already seen some ways to cut, be a little bit more lean in the projections. Like, they're truly engaged. They're a student. They're very engaged. They understand their financial numbers. Like, they understand their financials like the back of their hand. I can't stress that. If you come to me and you don't understand your break-even points, you don't understand your sources of revenue, where it is coming from, you don't understand how much working capital you need, we're in trouble already. We're in trouble from the door. So I think having a command over your financials, really being truly engaged in the student of the project you're working on, and having success that is going to move forward into the market and be successful. I think those are key. And really your liquidity position. How can you support your startup when, not if, but when there's a struggle, because there's always a struggle at some point, being honest. When that struggle comes along, do you have the financial backing to weather the storm?
Mm-hmm.
So I think these are three key points, and what I see and what we look at when we're underwriting a deal.
Gotcha. Hope, what about you?
Yeah, I guess just thinking about the dynamics of the team, a team that is willing to listen and take some coaching from others who have been there before. I think the nature of the business is, it's new, it's startup. You don't know, you may not know as much as you can plan to see what's happening, what your trajectory is going to be. Things are going to happen, and you need to have those people in place that your team, whether it's your CEO or other folks, can go to and get some coaching from. I just think there's so many folks who think they know it and they're just going to go it alone and just do it. And that's when you use your board. That's when you use people who've been there before, and other investors who can assist you. So again, keep in communication with them and listen. And I think you'll probably be successful.
Yeah, Saj.
Yeah, so Terry, in my prior life, I was a VC, and when you talk to other venture investors, there was a question of, do you bet on the jockey or do you bet on the horse? And by jockey, do you bet on the entrepreneur? And by the horse, do you bet on sort of the product, right? Like what's kind of determinative in terms of success? I've always found that I bet on the jockey. So it's the team that is going to figure it out. And so I'd always bet on the team, and also, so as I mentioned before, like maybe the original product or idea that you had is not the right one. And so you got to pivot. So if you have a team that's nimble and flexible and creative, I think ultimately they're going to succeed. There is a third dimension though, as well. And that's how long is the racetrack, right? And that's really a proxy for market timing. So, you could have the right team, you could have the right product, but you might get the timing wrong because, maybe, you're coming into COVID and, and you're launching and the market's not, receptive, or, sometimes on the healthcare side, in terms of, where you are in investing versus competitors, right? If you, in the technology space, it's the same way. If you're too early into a market, it's going to take a lot of cash, to kind of get you through kind of market adoption. But then if you're too late, right, there's competitors that are always already ahead of you, you could be in trouble. So the guys that have the right team, the right product, and have a good sense of how long that track is and how much money they're going to need to kind of get down the track are ultimately the ones I think that are going to be the most successful.
It's you already talked about teams. It seems like that's very critical. I mean, I see a lot of folks and they do try to go it alone. So I would reiterate to the folks that are watching that your team is very important in how you work together. We do have another question. The question is the following: my startup idea is in the entertainment industry. Is there any hope in trying to access capital now with everything that's going on with COVID? Can you talk on the hold on, it says, can you talk on the ground situation right now? So can you just talk about what's going on today? Anybody want to take that?
I would say right now in the entertainment industry, almost 100% of it, almost 80% of it is virtual right now. And live shows made up a lot of the entertainment industry, but there are still partnerships taking place out there. It depends on which aspect of the entertainment industry you're in. You need to create a following first. You need to have some type of social media presence before you get backing from any major industry, or you're able to go to a financial institution and look for funding, because it's It's all based on how much awareness you create from your audience, what type of audience you have, how engaged are they, and do you have some type of monetization of that audience? You see where industries, entertainment industries, look at social media, YouTube, Instagram, Facebook, LinkedIn, and how great are you at monetizing that audience? So I would say first, build your base, build your audience, show some revenue from that audience from what you're doing from the ground up. And then from that point, as you build that up and you build some form of base and you can show a track record, there's always an opportunity from that standpoint to look for financing, and then look at a partner that believes in you. If you have an investor that believes in what you're currently doing or your art and believes that it's going to go somewhere, and maybe that person has background, has skill set in the industry. Maybe it's a manager that's managed multiple artists that are out there in the entertainment industry. Then that gives you some backing. That gives you the ability to go somewhere and say, hey, this person may be the next whoever. So there's some thoughts.
Yeah. For everybody, you talk about this one question talked about COVID-19. We've been talking about it as if that's kind of like, de rigueur today. That's the status of the world. Talk about how you've been networked with as it relates to opportunities with, new partners, for you, Hope, new chemical entities, if you guys are in that kind of space. How do people get that relationship so that they can ultimately get to the capital? Because we're all on Zoom now.
Yeah, we're all on Zoom now. No more happy hours and networking events. But yeah, business is still being done. Deals are still being done. So I don't want people to think that this is the status quo forever. We're gonna, things are happening. A lot of it is from relationships that may have existed prior to the pandemic. Relationships that were started then that you're building on now. And then if you didn't have those relationships, using existing relationships to build new ones. It is possible. There are things that are happening. Events like this and other networking events are happening where people can get to know each other. But definitely keep leveraging those contacts. You can still network with people through Zoom. You can still set up meetings and talk. It's amazing. I was talking to some colleagues about this. How do we do business development in this environment? There's just a lot more communication. Before, you used to sit across the table from someone at dinner and build a relationship that way. Now we're talking a little bit more because it's important. So I wouldn't give up hope, even with that question. Don't give up hope. Keep going out there. It depends on what your business is, but you see if there's a market for it, and reach out to your network and let people know that you are looking. Let people know what you're doing, because it's hard to network and raise money when you're not telling anybody about your plans.
Sure.
Yeah, Terry. Yeah, I would say that networking has changed, right? It's become. I think you have to be much more deliberate and much more strategic about it. As Hope mentioned, the industry conferences, those networking opportunities, the dinners, the meals, those have come to a temporary halt. They will come back, but what you probably don't have as much is the travel, right? So traveling to different cities, traveling to different events, those plane flights, those train rides. And so, that opens up more hours in the day to have more conversations. And so I think, while, you can pack a lot more kind of at bats with, different folks, and so I think that lowers the bar for, hey, should I take this meeting or should I, take this conversation? Because, you can fit more of those in to a given day because you don't have the travel. The one thing I advise, a number of entrepreneurs is, because you have to be more creative and more strategic about networking, you almost have to make that part like a job in and of itself. And I think a lot of times people don't take advantage of all the networks that they are already members of, right? So, you have alumni networks, and, that might be where you went to college, maybe where you went to graduate school, but also the different companies that you might have worked with, either currently or in the past, they have alumni networks. And so I think, as long as you have, sort of a common bond, with someone, you're able to look them up on LinkedIn. I think if you sort of reach out, Again, you might have to reach out to, twice or three times as many people as you might have reached out to in the past. But at the end of the day, you're looking for that one check or that, one or two investors. And so, casting that net wide, being strategic about it, and then also, not being afraid to reach out to networks that maybe you haven't tapped in the past is a great way to, to sort of adapt to this, temporary world that we're living in.
Sure. Richard, before you go, I wanted to go back to something that you and I talked about on the phone prior to this, which is access to capital for people of color and women. So can you talk about that, how you've seen that in the SBA, in the SBA and small business loan world, and what are some of the things that you would tell people? What are the mistakes you've seen people make? What are the things that they can do to enhance the likelihood that they'll get the loan or get the capital that they want?
So, great question, timely question. I would say, one, be prepared. I think for the first round of funding, a lot of minority entrepreneurs were not prepared with the information needed. They didn't have their 940s or 941s for payroll tax. They didn't have their tax Excel spreadsheets breaking out the employees that they had on their payroll. They didn't have their tax returns prepared already. So it's really having that information. So I would suggest really creating almost like a COVID-19 stimulus survival kit. And you have it ready on your desktop with all of the information that's going to be needed, from the charts, from, if you use paychecks, from paychecks, your 940s, 941s, tax returns, everything in there, right? So you're ready to apply. And also, I have to really put a strong statement on apply. There's individuals that I literally looked at their financials and say, you qualify. Well, I was told by X financial institution, I don't qualify. You do. And they was like, I don't know if I want to go through it again. Be persistent. Push forward through it. Apply for it. A lot of times, and I can speak to this, you look at the news and you see many minorities are not receiving the stimulus. They're not getting the opportunity. And then some minority entrepreneurs become defeated before they even take a swing at the plate. Mm-hmm. Right? Mm-hmm. So get past what's being presented out there in the media, take advantage of it, get your package together, be prepared, because the next round is coming. They're having a conversation right now. The next round is coming. Begin to build a relationship, create a relationship with your financial institution. In the first round, you really had to, you had to have some type of relationship with your financial institution, right? Mm-hmm. To be able to submit that application, had to have some type of business relationship. So for the minorities that are unbanked and you have a business, don't run that business no longer out of your personal account. Set up a corporate account. Have a conversation with your relationship manager. Get an understanding of what the documentation needs. Create the survival kit on your desktop, and then apply and be diligent in that process, because there's a lot of grant opportunities, stimulus opportunities that you want to take advantage of, and it's just being prepared. Sure.
We talked about creativity a little while ago. I think, Saj, you mentioned that. So I'm going to go back to this question. Once a person in our audience said, how much creative license is okay and even expected when telling the story of your startup? I've been advised to inflate everything because investors assume that is what you're doing and figure the real numbers are half of what you said.
Yeah, well, look, I think I don't know if I would follow that advice. I think really important, sort of criteria for investment is your credibility, right? Because your investors want to know that they can sort of rely on you and your judgment, and that you're ultimately going to try to do what you say you're going to do. So, look, I think a lot of times when people are evaluating financial projections, they have a practice of discounting them, but that's just part of the kind of the financial, diligence. Ultimately, there is there's a bet that they're going to have to make, and particularly on the venture side, it's sort of a question of, do I really believe that the market is big enough, and what these entrepreneurs are bringing to the table is sufficient, to go after and get, a meaningful, slice of it. And so, because if you really are going to inflate, your projections and things of that sort, that sort of erodes your credibility, and ultimately you might make it past the first round, but when you're trying to raise money again and, et cetera, that those types of things, that will expose themselves. So I would just say, be credible, be authentic, just be, honest about what you think you can do. And you may be right, you may be wrong, but your integrity and your credibility is paramount, when talking to investors and partners, and, as it is in much of life, right?
Sure. Hope, were you gonna chime in on that?
Yeah, I can. I totally agree with Saj. I mean, your credibility is everything. You can definitely go in bold. You can make some big, bold assumptions, but you need to back that up. And if you can't back it up, your credibility would be destroyed. If not initially, then in any kind of subsequent round, you will be found out, if you will. You do diligence. So I mean, the investor's going to do some diligence as well, especially in my industry, but I think in a lot of industries, the numbers are important, but you look at the business itself as well, and the product, and what are they saying about what this product can do, and are they inflating that? So yeah, I agree. Be truthful, honest.
And on my end, I agree as well. We actually document. You inflate your numbers and you default. You're documenting. You can't go to another bank and apply for SBA loan. You have to disclose that you've defaulted on government debt. So your track record, your credibility, it follows you from any institution, from one institution to another.
Yeah. Well, I think, the key thing there is kind of integrity and credibility, and I hope people don't oversell as they hear what the panelists are saying. We've got two related questions that came through. The question is, my company is about providing LGBTQ focused training, not a new product. This training, our team really thinks large businesses need. Do you have tips for raising money and getting started in this sort of service business? And then, somebody else asked, because it's a service business question, how is access to capital for service business? It seems like it's a real problem. Can you all speak to that?
Well, maybe just on the first question on the LGBTQ focused training not being a new product. I mean, how are you differentiating yourself? Think about that as you're preparing to make pitches to investors. Again, in my industry, but I think in a lot of industries, you may have a Me Too product, but there are some different. How is it different? Are you delivering it in a different way? Is there something unique about your training that may be more effective than the way that current training is being offered? So think about that as you are differentiating yourself and preparing your presentations to investors. And then also think about the demand for your product. I think the comments about large businesses need this. I always say people overlook the market. It may not just be large businesses that need this. There may be other companies, smaller companies, other organizations, government organizations that may need this. So think about the market, and if you can do it in a credible way, as we've just said, and make your argument, that may help in raising funding for that type of business. It's not just another training program coming on the market.
Sure. Saj, you started talking about GSI, and I don't know that everybody picked up on this, but you guys worked with some of your customers early in the business as a funding mechanism. Did I hear that right? That you were?
Well, no. Well, I think I think what I was saying was that in order to build sort of the infrastructure that we had, we needed to, sort of commit to making, infrastructure investments, technology investments. And so we were going after long-term contracts. And that sort of gave us the ability to kind of raise, capital, because the understanding was that these contracts we would get that return on those investments during the life of those contracts. So thinking creatively about how you structure your relationships, sometimes give funding partners that confidence that you'll have the runway to make some needed investments.
So Richard, we've got about 2 minutes left. Do you have a parting sentiment you'd like to share with the panel, with the audience?
I would say that, continue to build that relationship with your financial institution. Continue to pursue what you're passionate about in the franchising space. If you have any questions about it, I am an advocate. I'm passionate about this. Feel free to reach out. I'm more than welcome to have personal one-on-one conversations. And at WSFS, we stand for service. So I'm here to service you and be a servant leader to you. And I'm glad to be a part of this esteemed panel and have this the dialogue and conversation.
Well, thank you, Richard. Saj, thank you. Hope, thank you. I really appreciate the vibrant discussion and the feedback that you've been able to provide and the insight that you've been able to provide to the folks that have questions and are concerned about how do they access capital amidst COVID, or just generally how to make those pitches. And again, the Rise Up Philly conference has been tremendous for me, and I'd like to say again thank you to all of you. And we got a 3 o'clock power hour conversations. So if you're looking at this webcast, you can go to those. And I think, Richard, you have one, don't you?
Did one prior. I did an Access to Capital one prior. So definitely here to support. I'll get on as many as that I need to.
Well, thanks again, everybody, and thanks for watching.
Thank you.
Great.
Thank you, Terry.